more minutes, so do grab a seat and make yourself comfortable. Thank you. Hi everyone, thank you for coming down today. I'm Zing from SGInnovate, and today we are very happy to collaborate with AngelCentral to bring you Why Angel Invest. At SGInnovate, we believe Singapore has the capabilities and resources to tackle hard problems from around the world, and part of our efforts includes knowledge sharing sessions like the one you're here for today. So without further ado, I'll pass the mic over to Dershing from AngelCentral, who will be sharing more about what they do. Dershing, please. Oh, okay, sure.
See how it works. No, doesn't. Wait a while. Okay, it's a bit slow. All right, okay, welcome everyone. Good afternoon. My name is Dershing. I'm here to do the intro, right? I'm a very active angel investor together with Xiaoning, Tengmo, and a whole bunch of people at AngelCentral. So I'm just going to share a little bit about what we do. So AngelCentral, our goal is very simple. We want to build a community of effective angels, right? So effective to me means long-term and sustainable, right? Not a one-off, you just hope you are lucky, invest a few and then you run away saying it doesn't work. Or you got really lucky and it just worked very well, but actually there was no methodology behind it, right? And then of course for it to be effective, the startups must be helped. Right, one of our key tenets is that we are the cheerleader after we invest. If we think we are the star, then better go start our own business, right? Don't be the investor behind. So our goal is, why we did this was because all three of the partners of AngelCentral, we actually retired a few years ago, and then found each other because we co-invested in some startups. Right, and then of course we all have our own journey. We tried different stuff. Some worked, some didn't work. But the one that stuck was angel investing. And I think this, and then we tried to analyze why. And actually, it's because we discovered that there were very little qualified angels in the region. Right, I think in the US it's 1 in 1,000. We through some data we found for this region it's probably 1 in 10,000. Maybe it's better now. Right, and also a lot of the angels had no methodology, very ad hoc. A lot of angels didn't do a portfolio approach. They actually invested very much like a chairman model, or they invested at whatever catches their fancy without a deliberate strategy. And of course, we discovered that a lot of people were supporting startups, but very few people were supporting angels. I was shocked that there was very little proper syndication going on. Syndication was done using a black book. Literally, and we had one angel tell us that when he goes on holiday, he's got to pass the black book to the wife. So that at least if anything goes wrong, the wife knows who owns how much shares in all the different companies that they co-invested, right? So that's not very good. And then, of course, we found some angels had very wrong expectations. Like some angels actually think that they are the star after they invested, which is wrong, right? It's the other way around. Otherwise, don't do it. You can start your own business, right? Of course, there was some market shifts also because Singapore has been reasonably successful in building our ecosystem. So a lot of our VCs that were funded in the beginning and had leverage from the government, they still have it, but they moved on to Series A and B, right? Because the AUM makes more sense, they have more fees, they can pay for their proper headcount and do things properly, which leaves a gap at the angel, at the seed and pre-seed rounds. Okay, and then of course, as the ecosystem grows, we realize that the quality and quantity of startups have improved tremendously, and this is really true, right? I mean, me and Xiaoning have been in this line since year 1999. We were the first .com boom. Back then, not the quality of entrepreneurs, especially after the bust from April 2000 onwards, all the way till 2011, the quality wasn't that strong actually. It only started getting stronger in recent years. Okay, so what do? We started in February 2018. But actually, AngelCentral as a community effort started as early 2017, right? We started with a lot of angel learning because we thought that the best way to bring people on board was to just share how we do our angel investing. And we are very mindful, we only have one, we represent one methodology, Tengmo represents a slightly different methodology, right? And actually we hope down the road to show different ways of evaluating, different ways of choosing startups. So we've trained quite a few hundred people, and then from there, a lot of them came to us and said, hey, then why don't you offer me deal flow, right? And then we realized that the more we invest, so between me and Nick, we've done around 28 companies, right? So the more we invest, the more startups start to come to us. So when we first started, maybe you get 200 pitches a year. Last year was 400. This year is around 700 over, right? So much so we have to build a system for it. Our deal flow is curated. On the platform, if you log in, it's not. You can see most of the startups that come to us. Right, that's what we give to our members. You have access to see our deal flow, but you have to pick on your own. But for those that every month we select for pitches or we syndicate, then obviously it's vetted by either one of us. Okay, and the last thing we do is we do syndication services. Okay, two reasons why we do syndication. First reason is bite sizing, right? Syndication allows bite sizes to go as low as 25,000, whereas prior to that, most investments have to be 50 or 100K, right? Which, if you follow a portfolio theory, actually cuts out a big size of the population. Okay, so we try to make it a bit wider, but of course, angel investing is very binary, so it still should be cash, spare cash, right? And then the second reason is governance. So when we run syndicates, there will be syndicate leads, right? And the syndicate leads are people that are supposed to know what they are doing. They have evaluated the company, they represent your interests. AngelCentral syndicates need to put money. We don't like brokers. I'm very clear about this. Okay, we don't work with brokers at all, right? And we don't give referral fees at all also. Okay, so AngelCentral syndicate leads usually are exited entrepreneurs. Like you run your own business, you create a certain size now, you're retired, so you're leading around and you're already investing at least 50, 100K. Then people follow you, right? Okay, so that's what we do. What we have done, I alluded to it. In 2018, we trained 200 angels through our workshops. We've tied up with SUSS. We've got very deep 4.5, 5-day one. That one you can use your skills future, right? We also have the 4-hour crash course ones run on Saturday morning. Okay, they are usually all quite popular. We feature around 40 startups. We track actual funding, right? I don't think any angel group actually reveals it so openly. We did around 3.8 million last year, right? This year we will definitely double it. All right, the number of startups we review, like I mentioned, around 400, and we have a broader community list, of course, right? So around 600 of them. And we started syndication only last year, so we've done 3. This year, we have already done 3, and there's one more that just got filled. We've trained 120 angels, 30 startups. Funding, like I said, will definitely be way more than last year's 3.8. Okay, and the startups we review should be around 700 by the time year end comes. So 700 is a decent number. We estimate it's around maybe 10% of the entire regional number of startups, right? So because Singapore generates around 850 to 900 or 1,000, you know, who you believe, fundable startups, high growth technology startups annually, right? So ours is regional deal flow, but the bulk is still based in Singapore. Okay, this is an example of last year's startups. This is Xiaoning's categorization. So essentially what we do is we have 2 layers of cut, right? So if you are a member, there's actually a system now, you can log in, right? You will actually see everything except the Martians, right? And the not readies, okay? So that you can actually better take a look at companies, you can get a sense. But I will strongly recommend don't just anyhow invest, don't just anyhow indicate interest. Okay? Because we put it up, it just means to show you the kind of deal flow that's going on. If you want to invest, you want to really participate, I suggest come for our workshops. After our workshops, then start attending our pitch sessions, because the pitch sessions are curated by us. So every month we have a pitch, 4 to 5 companies. All right? Cannot move already. Okay. We are streaming this to work. Oh, okay. So I should say hello to the people at work. Yeah, because we actually have a co-working space that in Malaysia, and I think there are attendees over there also. Whoa, okay. Yeah. Are you moving or am I? Okay, you don't move, I try. Okay. Yeah? Okay, so like, I was talking about the angel learning, so this is what we do. We believe this is very important because we've got to get the right information before we start to invest. So we have 2 main things. One of them is all the need to know stuff. the master class. We cover how to think about your portfolio, right? And then how to view angel investing and VC investing within your portfolio, right? Then we cover how we evaluate, right, the startups. Then the next part of the master classes will be legal. So we'll cover what to do, how to read subscription agreements, note agreements, what's the difference between safe and note and all this kind of thing, right? And then after that, we actually have due diligence. We just created due diligence and post-investment what to do. Because actually once you hit 20 plus investments, there's actually a lot of things to track. Right, you can't just track it like it's on the palm of your hand. So it's quite tricky. And whether to follow investments, not to follow, everyone's got different strategy. And we use real data of our own portfolio to share whether it made sense to follow or didn't make. Okay, the answer is it does, make sense to follow. Okay, and then of course we also know that there's a lot of gaps in knowledge. Like me and Ning, I think we're B2C experts, we are SaaS company people, right? Tingmo can do hardware, right? But we don't have med tech and things like that. So we started creating verticals whereby we get entrepreneurs who have raised money or sold their business to tell you how it was like, what are the metrics they track, okay? Because actually at the end of the day, the stars are the entrepreneurs, don't forget that, we're backing them, right? Consultants, I think, quite different, what they were sharing. Oops, doesn't move. Okay, so syndication I mentioned already. I'm not going to go into detail. Of course, syndication is where we make some fees, because our fees are very cheap. To be our member, just 500 a year. If you pay 1,200, it's for unlimited attendance of all our workshops. So it's a really good deal. Of course, if your family office is a bit more expensive, but you can send 3 representatives. So we have 100 over paying members already. Most either corporate, exited entrepreneurs, second gen, or family offices. All right. Yeah, so these are some examples, and founders like us, okay, our model, we are very clear, we hardly charge founders anything. To come to pitch is free. The only time we charge them is for a bit of legal and setup work, and it's just capped at $5,000 if we syndicate money for them, right? So it's a very, very competitive model. This allows us to get the best founders. Because I think if you go to a platform that doesn't charge you and charges the founders, rest assured the founders, I think you're getting substandard companies. They are the one tier down. Right? Because the best companies don't need help, actually. You have to seek them out. Yeah, so these are what some of the founders tell us. Yeah, we work a lot with the ecosystem. So our sponsors are quite a lot of VCs. You can see they are the good VCs in the region. And actually the VCs sometimes send their analysts to be trained by us also. Right? Because our methodology, I think, is pretty well thought out. Yeah. Okay, and investors, so I mentioned we've got all kinds of investors. We've got people that are here just to learn what is it like, and then they pay for the membership, they attend the pitches, but they don't cut checks. We're totally cool with that, right? Because you must be very comfortable before you start, okay? Of course, we've got some, like Victor is pro one, their family is, they own manufacturing plants, he's based in Malaysia, so he actually invests a lot of our startups, right? Jane is here, later she'll share about herself. Jonathan was a city banker, right? So we also have a lot of bankers who are either very bored or they want to learn a lot of new stuff, so they come. Some are retired, some are not. And Yuha is a founder, so that's the other demographic. So he's a founder of this company called Non-Stop Games. They sold it to Kings, the Candy Crush Kings, right? Yeah, and then now he's back in. He's in Berlin now, yeah. He sold his business, retired, does some investing. Yeah, he's called, yeah, never mind. Okay. Okay, our platform, last slide already. Okay, so our platform, we've actually been, I think we're the first angel group to build a proper platform. So you can actually log in, you can see all the different deals we have. And in fact, this is a live deal right now. This is a Global Blue competitor. I'm leading this round, I'm going 100,000. We're actually at 1.47 already, so it's almost filled. In total, it's $1.5 million round. So we actually are pretty sizable in what we can do. We have done anything as low as 200-300K syndicates to now as high as 1.5 million. Yeah, so this is a very interesting company. Singaporean founder has a license from IRAS to compete with Global Blue. Every country only has 2 or 3 such licenses issued. Okay, so I reached the end. We run regular coffee sessions, right? So please feel free to visit our website. If you're not sure what membership entails, what is it like, if you're interested to find out more, just sign up for our coffee chats. You will meet either me, Xiaoning, or Tingmo, and then we will have a 1-hour session just to share whatever you want to know, right? Then after that, the only way to really get involved is to start doing, right? Doing not in terms of investing, but doing in terms of talking to startups, meeting fellow angels, figuring out what's your methodology, okay? Honestly, for our workshop, I suspect only 1 in 5 end up really investing. Okay, because the asset class is really not for everyone. Okay, but it's fun, it's fun. So why I do it is really because I like to learn. It's great to learn all the different industries, and then the other thing I like to do is I like to see the startups grow, right? So I'm like living vicariously through the startup, right? Yeah, that's really fun. Okay, and without the pain of HR, right? No one's going to quit. Okay, some people still quit on me, but at least I don't have to care whether the person's going to quit, how much bonus to pay and all that. That's quite a pain. All right, so I will hand over to Xiaoning now, and she's the moderator for the panel, and she's our chief angel. Yeah.
So I need to buy a wing, and I always wear the wing at the public events. Okay, so before I start, can I just get a raise of hands who are currently angel investing or looking at deals right now? Oh, that's great. Okay, so who has done about 4 or 5 deals already? Oh, this is great. Okay, this is very cool. So before I start, just background information. Today's RSVP, actually, we are close to 200 RSVP. So half of them were startups. So actually, that's why I tied up with SGI to say, let's do a webcast. So we actually send confirmed invites to investors to come on site. So the webcast is going to the founders in KL as well. So we have a collaboration with the co-working space over there to let them hear about our investors sharing here. So actually, Deshing alluded to that already actually in a lot of conversation. Angel investing is an investment asset class. Okay, so I think we'll come from there. So if you're not investing, please don't, in others, we will get our panelists to share about this, but if you're not investing already, you're not thought through about investment, please just hear more, don't jump into it yet. Okay, so without further ado, can I invite our panelists to join us? Take more, Windia, Jane, and Jia Yuan. And here, turn on already. Okay, can you hear me? Okay, so actually we have about 40 to 45 minutes today. So we actually have quite a large panel. So I will just have every panelist do a quick introduction of yourself, spend about 2 minutes talking about yourself, what you do, and maybe how you got into this.
Okay, I'll start. So my day job, I'm at NTUC in the online grocery part of the business, looking after partnership customer programs and B2B. The side hustle, not that it's earning me income at the moment, the side hustle is I'm active angel investor. A long time ago, I was in VC for a short period of time, and I was always more interested on being at the other end of the table. And then my last job, I had responsibility for innovation, and in that job, in 2 years, I met easily 100, 150 startups, but I wasn't in a position where I could invest because of my role. Once I was not in the job, I started to invest.
Okay, hi, I'm Teng Mo. I'm a retired corporate executive. I was a president at Motorola. So after I retired, I'm a busybody. I cannot sit still, so I end up mentoring for free at NUS, SMU, different universities. So it took me a long time to invest. The real problem is when you mentor a young team and you help them to fundraise, the first question they will ask you is, Teng Mo, are you investing? If you're not investing, why do you ask us to invest? So I end up investing. So
that's why he always called himself the accidental angel.
Yeah. So currently I'm a partner at AngelCentral. Probably it takes about 40% of my time. Right, the other 20% of my time I spend my time at Entrepreneur First. I mentor Entrepreneur First, and the other times is golf and family.
So hi, I'm Chia Yuan. I'm not retired. I still have a job. So I'm a program director in DSO National Labs. So I head cybersecurity R&D at DSO. That's at the high end of things in terms of cybersecurity. So the part that I love about my job is innovation. That is actually identifying good ideas, making bets on them, identifying the people to actually run the things. And I find that so starting about 2016, I realized that there's this whole world out there, startups, which is actually a lot about innovation as well. So I started first for my job, I started being a judge in the SG Tech. And then after that, I realized that, hey, there are a lot of startups that are actually very interesting. Wouldn't it be great if I actually can get to actually invest in them? And that started that was the seed of a hobby. So over the past few years, I've invested in 4 startups so far. This morning was considering the 5th one, but I guess, yeah, still thinking about it, yeah.
Hi, I'm Jane, and I guess this is the point where you think, gosh, what do you say about all those years of being in the workplace? I started off in Singapore, heading up and leading a communications marketing company, and I guess the excitement of that for me was the diversity of clients that we were able to look at. Our work was always in the B2B space, predominantly IT, telecommunications, and after that, I spent 5 years running a charity, so finally, all those years of communicating on behalf of companies, I was able to do it for the public good. And then 12 months ago, I was invited to go and help a property company, a family business, 3rd generation, and they felt that they'd reached the stage in their maturity that they wanted to put some of the money out of their property business into exploring what else they could do. For me personally, it's the greatest opportunity ever because it's a family that would like to do a little bit of good in the world as well as hopefully get some money back for what we're investing, but a focus on social enterprise and perhaps fixing the planet in our own small way.
Okay, thank you everyone. So again, I would like to emphasize the fact that it's one of the asset classes that you should consider to increase your pie, right? But maybe everybody can share a little bit, how do you see angel investing within your portfolio, or what other kinds of assets do you invest in? And let's try not to go down the road, let's try to understand.
Okay, so why don't I start? A Singaporean, you don't invest in property, you're not a Singaporean, right? So definitely you invest in property. And then, of course, when you have sufficient money, you talk to the private bank, they always tell you need to have a portfolio, right? So equity, bonds, alternatives, and all that. So for me, angel investing is an alternative investment class. So it's very illiquid, right? And the outcome is very binary. So never invest in more than 10% of my money. So my monthly expenses come from my bonds and equity and all the other things, right? But don't expect this from the angel investing. But
I started investing in stock when I was, I think 18 is the age that you could set an account, right? I can't remember. But whatever that age, that was the age that I set an account. And I have stocks, bonds, I have fixed income, I have, and angel investing is part of alternative investment. So I also, in alternative, I also have, I also lend through lending marketplaces. It's because, you know, I was part of I was active in Women in FinTech, so I was very aware of the lending marketplace startups. Angel investing is a sum of money that I've set aside, and I'm still in the process of trying to finish dispensing that money to a right portfolio of startups. But mentally, I'm very aware that it's extremely risky, and I'm prepared to potentially afford to lose all my money. I think that's that's a mindset that you have to take, even though for everyone that you invest in, you truly believe they can be a winner.
So I don't actually think of angel investing as investing. So because like Tegmo said, you're not supposed to, so from a risk management point of view, it's not wise to actually commit more than 10% of your assets to this class. So I thought which is why the title for today is correct. It's more than just about money. So you actually get your returns mostly in the other forms, in the form of actually learning new things, in the form of actually understanding new business models, working with people, the founders. And the money is actually secondary. Why I say that? And that is because so it will take a long time for you to get your returns because it's not so liquid. So your 90% will be the main one that actually gives you your returns, and they are liquid, and you can see them on a day-to-day basis, on a weekly or a yearly basis.
I'm the one that's going to give everybody courage, Because when you're an expatriate and you live in Singapore, you get all these phone calls from people saying, let me help you invest your spare money. And for 20 years, I said to them, I haven't got any at all, because I put it all back in my own business. So I've hung my shirt up out the window and I put it back in my own businesses. So that was, I guess, exciting because it's sustainable and it now runs across the region. Then one day I woke up and thought, well, DBS has got how many millions sitting in it doing absolutely nothing. I better take it out of DBS and do something sensible. Because the age word, people kept saying, you know, you're getting older, you need to think about these things. So I've got a bit of a portfolio around all of the asset classes, and of course the money that you can invest in something like your angel investing has to be, I guess from my perspective, I would think it's the fun money, it's the money that you can afford to lose. To be honest, it can't be anything more than that. So it's, you know, you can go down to the casino and gamble it if you want, or you can say, well, let me put it into investing and have all the joy and the excitement of doing some research into new areas and exploring and thinking what is going to work in the future. And I think everything that's happening in the world right now proves to us that probably none of us can guess it at all, but we can have a little bit of fun in that exploration journey. So that's mine.
I was just agreeing with what you said, that all the other asset classes are very, very boring, and the angel investment is a lot of fun.
So, because it's a lot of fun, can you think back to your first angel investment? How many companies do you go through before making that first investment? Or how long do you take you to decide on that investment, if you can remember?
Okay, so I'll answer you for Repso, right? We are, as a company, we're just 12 months old, and we joined AngelCentral because we liked the idea of somebody bringing us curated opportunities, the fact that you had already gone through them, and so attended 2 or 3 sessions there, and in fact we joined on your first syndicate, I think, for last year, which was Nimbus, and that was one of the earlier of our investments that we did. And I think, again, it fell into our umbrella thinking around a bit of a social impact, and it was bringing jobs to people and self-respect jobs to people who were a little bit neglected otherwise. So that was really important for us.
So background, Nimbus is actually it's actually an office cleaning service, but what they do is they overlay that service with technology. So because with technology, you can actually serve the office managers a lot better. Because of that, you can charge a premium. And when you can charge a premium, you can pass a premium down to the crew, to the cleaners. So in the past 1 year since we invested, actually Nimbus has managed to bring up the cleaner's salary from 950 to now average about 1,100. So to me, that actually, I mean, I led the investment. I think part of the reason why I really like the team is because they believe and they actually made it happen. But I think, honestly, the reason why I actually invested was because the founder is an Oxford grad, and I saw him scrubbing toilets. So I realized how sincere he is in investing in improving life for this group of people, and that's what got me motivated. Yeah. Sorry, let's go back to your first deal.
So the first startup that I looked at, that was I think the first time you think seriously about taking the plunge is very memorable. So because the first one that I took a look at, I looked at it for many months. It was actually one of the startups that came into the competition that was judging, and they did pretty well. And I thought the founder is great, and it was a great idea. So basically, it was virtualized. It was an app that actually allows you to actually try clothes online in a virtualized way without actually doing it physically in stores. So I thought that was a great idea. So I followed the founder over many months. I visited the office quite a few times. So that was the days when I think before AngelCentral was formed. So it was pretty exciting because I was pretty much alone, and there's And in fact, I was so on that I actually took the founder around to a few VCs that I know so that I can get a second opinion. It was extremely painful. So in the end, I actually went through a lot of things together with the founder, even though I have not invested in the startup yet. It was actually just me doing my due diligence, interacting with the founders. So simple things like they were trying to actually, so they have a lot of letter of intent, and they were actually doing a white label for quite a few companies. And I realized that to my horror, they have zero revenue. And they're actually thinking about raising money to enter China without a solid base in Singapore. So I think after all that experience, I was glad that after seeking a second opinion, I decided to not to invest. And a few months after that, it ceased to exist. So that was my first experience.
In my previous job, I was in insurance. So after I first started seriously looking, for whatever reason, a lot of the startups I was looking at was in insurtech. I think maybe 6 or 8 different ones, but I didn't end up investing in any of them. Sometimes I think it can be a bit of a problem when you're really familiar with the space. So you look at it, you see all the negatives. Then I ended up making my first investment in a completely different field from insurtech, and it was one of the graduation cohorts from one of the early last year's EF cohorts, and they were developing data algorithms to analyze visual data, but what they were building was a social marketing influencer platform. And I met them when they were 3 months old, and I was so surprised that how much they already have learned and the insights they have in a field that 3 months ago they didn't know anything about. And I was also very impressed at that they were smart, but they were also street smart, and they were executing really, really fast. I indicated interest, but I said I like to see a VC lead because you're too lazy to do due diligence and valuation. And then we still went on for about 5 months before we actually closed, and since then they have customers, including agency networks in multiple countries in Asia. So I think they are doing okay.
So I'll tell you my story, and please do not follow me. Because after I left Pursuing Internet, I get a huge bonus for leaving the company. And my first investment actually had happened in 07 or 08. I put in 300K in a China company who want to recreate Foursquare in China. And I thought I was very smart because I got a lot of shares and all that. I was thinking it would be very successful, but it crashed in 6 months and all my money went cold. And I stopped investing in this thing for more than 10 years. And so after I of course, in reflection, we are always scolding ourselves for how can we be better? How can we learn to be better, right? So I was very afraid to invest. And after I mentored a lot of startups, so actually one of the first investments that I've done actually is doing indoor beacon, which is a business which Motorola used to have. So I know that business very well, but I did invest in them, and over time they ended up pivoting. So I realized actually whatever the idea they had, the execution had problems. So currently my investment thesis is very, very different. I only invest if I have sufficient time for mentoring and understanding the quality of the founder. I always look at the traction and what traction they have already before I invest. So, right, and if they need to pivot, I make sure that they pivot and change and prove the traction and the revenue model and all the other things before I put in the money. Right, so I'm much more careful before I write a check. But that's my very painful learning.
So just to recap a little bit, there's actually quite a few points that different people has brought up. So first one I want to highlight is actually in angel investing, you are never functioning solo, because our own experiences are in certain verticals. Like what Dan was saying, right? before the community came out, we need to bounce off ideas. And I think Deshing alluded to that. We actually found Techno from cap tables. So when we were doing angel investing, actually a lot of times, first few cases usually is in spaces that we know. It may not be directly related, but it will be in verticals that we have expertise and relevancy in. But then the thing is, the success bias. So like for me, I used to run AngelCentral. Now actually any HR tech job related come to me, we find fault with it because we have so much knowledge in it that we are biased against it. So it's actually sometimes we become very good mentor to the startup, but the thing is, it just makes it very difficult for us to put money with them. But go back to the point that actually you need a community to support you, and that's why now actually, like whenever you look at SaaS model, right, we actually bounce it off with Royston, and then tech we send to Dr. Prem, and then who else do we send things to? Cybersecurity we send to Jia Yuan, and then if it's AI side, actually was bounced to Joe and then different people. Gaming side we send to Yuha. So actually within the network, we actually try to get each other to support and give the validation. But I think key is actually the community and the doing it together. But the key is do not follow blindly. We had some, so yesterday, not to name names, yesterday on Tuesday at the office visit, we realized one of the angels following blindly. I think Deshing got a shock of life, and then he straight away say, can let's go for breakfast so that we know how you're doing it. Please do not follow blindly. So on AngelCentral, we actually don't recommend what you should invest in. It should be something that you listen to, you enjoy, and then you raise hand. Later we'll ask Calvin to share also how he actually because Calvin keep laughing. So later we need to get him to share a bit.
Actually, in the beginning when I started meeting startups, I find that I was going, oh, I like this one, I don't like this one, I like this one. Then I thought, okay, I need a better structure in trying to understand why I was liking certain things. So I took the time to actually sit down and write my own investment thesis to say how do I think that the world is going to change? How do I see value being created? And where? So it gives me a better idea of where the areas I would like to invest in. And then I also end up writing out for myself what are the kind of founding team that I would like. Because I think that's very important. When we are investing in so early, we are investing in the people.
Just to advertisement a little bit, you see that there's a Slido. So if you go onto the website on the Slido, you type in Angel Invest, you actually can post questions to us. But now, let's say there are certain thoughts that you want to ask, you just type this, and you can actually see other people's questions. So for those people on the webcast side, on the livecast, you can do the same thing as well. Then you can see the questions of other people are asking. You can put it up if you want us to carry it. So later we will address those questions after we finish.
So I think I was just going to pick up what Wentia had said, that the organizations that we're looking at, obviously from my own background, I've worked with companies from SAP and Oracle at one end to highly specialized, very technical, small niche players at the other. But the idea is one thing, the technical expertise is another. But at the end of the day, they go to markets. How many of them, in fact, quite often will let themselves down because that brilliant idea isn't going to go anywhere if we can't get it out and get it in front of the people that we want. And today, there's so much. I'm going to just, post it up with a few Facebook ads, and I expect, 50,000 people to immediately sign up for the app. And I think from experience, we all know that's simply not going to happen. So I think
actually, one question for Windya and Jiayan is actually both of you are working. I mean, the three of us we have a lot more flexibility with our time. So can I just understand a little bit, how do you juggle? Because 9 to 5 commitment, weekend got to spend time with the wife, spend time with the husband, how you find time to do your due diligence?
So I think I'm lucky that I work in an R&D environment. So in the first place, it's supposed to be flexible. So having said that, yeah, it's supposed to be, not always. So sometimes due to last minute scheduling of meetings, sometimes I will miss a few pictures that I would really like to go. But I make up for it by watching the webcast after that. So I think we need but as long as you can separate the between your work and your hobby, I think if you have flexible timing, you can make up for the time. I think that works out to be okay, at least for me.
Time is an issue, definitely. Doesn't help that my office is in Jurong. So by the time I come down to meet the startup, it's like 7, 8 p.m. at night. But very often, first of all, you find the time. If you can't find the time to meet the startup, then you shouldn't proceed any further. But also, I think once I did a few investments, I also realized that because of my lack of time, I started to also explore joining syndications. There's a big difference in time commitment between investing directly and joining a syndication, because there's so much more time you have to spend in the summer, so much more meetings, so much more paper to go through, and so much more agreements to go through. Whereas in syndication, there is a lead that you can talk to. And you can sort of write off a lot of the work that they have done and the questions that they have already asked. And I found that gave me a bit more balance. So half of my investments are syndication.
Okay. So far. Oh, okay. We got to articulate better. Okay. Actually, I want to just ask a little bit. Hopefully, it's not a wound that's raw and painful. Any nightmare investment stories? I don't think when I share one. any raw stories that how did it, meaning that it didn't work out, and then Jiayuan don't have raw stories, so there's any painful stories, and then what's the lesson that you got from there, if you could share?
I did say that I worked for a family, so the worst story is when I'm introduced to the bright young thing with a great startup idea who's a friend. And then there's a choice. You can kind of say, well, this is not good, and let's just all run. Or we could have a bonfire and just set fire to the money. We could do lots of things with the money, but we shouldn't give it to him. So, of course, we have had a couple of interesting occasions where perhaps it has been an emotional investment. And I think, honestly, everybody surely has their emotional investment. So that's probably the warning. If you feel that it's real love, then maybe you shouldn't do it.
Any other war stories?
There was a couple of years ago, there was one where, first of all, I've known the founders for a while, but in other capacity where, in my work, I had some interaction with them. And they had approached me to invest in their business. And I was finding it very difficult to get a grip of sufficient data about what's going on with their business. But at the same time, the problem was that I knew them for already over a year. So there was an element of trust from knowing them, and then that was not matched by the amount of data that I need to be able to decide whether I make the investment or not. But it was just through a pure coincidence that I ended up talking to somebody else who seems to have said that they had an issue with their business, and turns out in the end, I found that they were severely in debt. But even when they were severely in debt, they were trying to get a lot of money from me, who is somebody that I knew and I have been working with for over years. So I think things like this do happen, which is I think partly why it's quite important for us to do our homework. Yeah.
Okay. One more question about good stories, success stories that you think. I think one has success stories.
Yeah, I have. Okay, so one of the best things that I've done, what I've learned most about angel investing is the ability for me to learn much more about different businesses, different industries that I've never had the opportunity to do with. And the other opportunity for me is to challenge myself to using my experience, my intellect, to see whether that can be applied with that vertical. So since then, I've invested in a property company, a startup, equivalent to Airbnb for corporates. I've invested in home care services, Homage. I've invested in IoT, crypto, custodian services, which is a financial service which is not available in crypto currently. So a lot of verticals that I previously didn't get a chance to do because my background is IT and telecoms, right? But at the end of the day, I learned much more about, number one, using fundamental first principle business models to challenge yourself. That's one thing I learned. The second thing I learned is, at the end of the day, is a person. And how do you encourage the person? How do you coach the person? How do you help the person to be better? And at the same time, I get better also, right? Because I learn from him how he solves problems in different ways when I was growing up, I would never hire young people to do a lot of work and give them good responsibility. But now I see all these startups, young people just out of university and tremendous responsibilities, and they do their job so well, right? So I'm very, very encouraged by getting much more learning from these experiences. So beyond the money, of course the money is important, so I make sure that my picking of the startup, my investment, my outcome is good. But I get much more over my life learning my energy.
So this is what Jane kept saying is actually gray matters, and then the second boost, right, in our values in life.
I think that learning is really enormous, that you suddenly, the blockchain word came from nowhere for all of us, didn't it? And I guess, we had a choice as to how much we wanted to invest in time and learning around that. I think the other amazing opportunity for me, again, as a family fund, has been being able to explore, again, that young talent. We've had a couple of startups come in our direction, and it has been, they're not ready yet for the investment, but we've been very happy to commit the time and the resources and the space and the mentoring so that they're able to pull their product really together. And I think that's a luxury that most people probably don't have. And that's been joyful.
Actually, everybody alluded to that. It's the founders that is actually the key factor that you're looking at because of the trust, experience, after mentoring and all this. So actually, just to share experience, last year or the year before, we did a deal with the family office. The family office was going to start up SGIN for the first time. And for due diligence, they hired a big four to do financial due diligence. So of course, the recommendation is do not invest, right? Because the due diligence discovered that the founder has no idea what cost of goods sold means. So the classification was all wrong, and then it was not revenue-based, it was not even accrual basis. So the first meeting that we had was actually explaining to the family office how to do this. So coming back to share the story, I want to get a sense of how do you transition yourself from, because when you're doing bonds and equities, it's very financial-based, right? It's very number-based, you have cash flow analysis and things like that. But in the startups, it's people-based. If somebody tells you can do net cash projection, I think the person must be dreaming. So what do you look for in the founders actually?
So I think the similarity between angel investing versus the more conventional kind of investing, say in the public markets, buying a stock or a bond, there is a certain fundamentals, except that for startups, it is not that clear cut. There is the founder effect. There's a qualitative aspect of that as well. So in terms of the hard numbers, usually we'll be looking for traction, and by traction we mean one way can be revenues. During the .com years, there was the eyeballs. That's not valid anymore. So in terms of revenues, so usually if your revenue is significant, say 6 figures, 7 figures, and you're actually growing month on month at a decent rate, that is what you would call traction, and that is I think the first step to at least for me, to be seriously interested in a company. The other aspect would be the founder, whether the founder is laid back, or the hustling, that makes a lot of difference. Does the founder actually understand the entire business landscape, the business model? So all that can make a lot of difference.
I think that the story of the founder, one of the aspects is, the leader, where he's got three of them together and they've just founded this and they're absolutely tight. But then what is their potential to grow? Because at the end of the day, success is going to be like any of our organizations. Is that one individual going to be able to keep that vision on the wall and get a growing team behind him? Particularly fast-growing organizations have so many challenges, and if it is going to be a successful startup, then it probably is going to be extremely fast-growing.
I think for me, first of all, it needs to be a space that I'm interested in, and I think that there is value creation that can be realized. Then for the startup itself, there are two things that are really important. One is the ability of the founding team to learn. Because the reality is that I expect that when I'm investing, they may have painted a whole idea of what they're going to do. As they start to execute, they are bound to encounter data that is going to suggest that they should make changes. And the ability to learn as they are executing is really, really important. The second part is obviously there are any signs at all that they are able to execute. Because at the very early stage, there are many startups that are very big on the ideas, but they are very low on the execution. So you really do not know whether they can execute. And that is something that is very, very hard to assess.
So if any of you are familiar with the startup life curve, you will know that actually in the front part at the valley of death, people who typically angels invest in this period at the valley of death, and terminology-wise, people who invest in this group are called the FFF. They're called the family, friends, and the fools. Okay, so I think part of what we're trying to share today actually is, even though it's a high risk, it's actually something that it's monetary-wise, actually financial returns could be very high. It's high risk, high return. But at the same time, I think you owe it to yourself to make sure that you do enough homework and not blindly follow. If you really want to gamble, I always tell our members, if you want to gamble, don't join us, go Marina Bay Sands. Because we are not here to gamble, and we're not here to follow blindly. So that's why this kind of platform, where for us to actually learn from each other and build the friendship, build the community, and learn from each other. So actually, without further ado, I think time is, we have quite a few questions that I just realized. Actually, if you guys get into the slide, you actually can see, but I'll just read it out, the questions. So the first question that we have is from Philip, that says that, hi there, you mentioned on your website that you're not a fund, even though you structure SPVs in a risky asset class. Which regulation do you fall under? So to be very clear, AngelCentral has no fund behind AngelCentral, so it's actually individuals coming together to fund the startups. We are not a broad-based crowdfunding site, if you know what I'm saying. So we are not open for the whole world to see. Only members can access the deal flow behind our setup. Okay, so in that sense, we are safe, based on our lawyers' recommendation, we are safe with the MAS regulations and everything, and actually I have a law society that potentially actually giving me the nod. So I hope that answers the question for Philip. Does anybody need clarification on this one? Do you want to add on to this? So to be clear, we're not a consultancy service as well. As in, we do not consult for you, we don't tell you what to invest. That's why we say through the pitch day, through the platform, you got to come to attend the pitch, and then you got to raise your hand, and then you interact directly with a startup to make a decision. Okay? Second question, maybe this one actually I'll get the panel to answer. Do you feel the odds are stacked against you as an angel? VCs usually negotiate better terms like liquidation preferences. Yes, wrong stage, somebody said that. Yeah. But you want to take any?
Yeah, so first of all, I would think that I normally also like to invest aside with all the VCs. So if the VC come in, I can follow the VC round. So I get the same terms as the VCs, right? But also if, for example, if I'm coming in before the VC comes in, then you must remember to have the right kind of legal terms to protect the minority rights. And okay, there are other clauses you can put in. You can put in clauses such as best favored nation, so that the future kind of rounds you can follow the same clauses. So that's why I would ask you, if you want to do this, you want to understand this, join our legal masterclass. We spend 3 hours explaining to you how to protect yourself as an angel investing at a minority shareholder.
But to just give a few basic clauses, we always make sure that we ask for, even for, so I mean, very, very bluntly speaking, angels' rights, because you're the first check to go in, we take the highest amount of risk. But as the next round comes in, usually your rights are overwritten. But the basic rights that we always ask for is your info right. Info right to the extent that, not to say that you must share your customer list and all those things, but on a yearly basis, because I'm a shareholder, you should actually share your progress, your audit numbers. You actually should keep us informed. So you will see that at the Series B, Series C, sometimes the next stage VCs, they actually will try to remove this because it makes life more easier for them. So that's why usually syndication will support this, because as a syndicate, so angels typically on a personal level, right, it's not more than 2%. So you think from the founder's point of view, seriously 2%, I would not follow up with you so diligently. But when you come together as a group, they cannot ignore you, because as an angel, you are typically, as a group, you're at least about 12 to 15% collectively. So that's why that's a benefit, one of the governance benefit that we were talking about. But I think the key is actually, as an angel, you want to provide value beyond the check. And that's why I think for some of the companies that we're working with, even though at Series C, we are asking for info right, they're willing to entertain us, because along the way, we have proven our value to them. Okay, so actually this is one thing that I think I forgot to bring up actually. For a lot of angels, actually our members, they were very shy. So one key thing about angels is actually you got to brand yourself so that people know about you. You know about your value proposition for this startup. So very openly, we actually, when we started last year, we had a banker who was actually very happily writing a check, but his checks were all not getting accepted. Because the startups are all saying, who is this fella? Why is he so generous? And he write check after the second meeting. So they were getting very worried. And so they were like, who is this person? You know, why should I take his money? So as an angel to provide, of course the check is a key thing, but in order to play this game long term, you need to provide more than the dollar sign. Okay, but be mindful also, you don't become a slave driver. That is a fine.
I think the good startups, they are also purposeful about where their funding comes from.
I actually want to have to wrap that up. So I actually, my opinion is that, so individually as an angel, the odds are stacked against you. But if you join as a syndicate, actually you have the edge. When I say that, that's because you're investing totally your own money, whereas from the VC's point of view, they would have other pressures to actually, well, maybe they need to actually get the money out by a certain quarter, or the money doesn't come in by a certain quarter. So they will actually be affected by the other decisions where you have an edge over. But to balance to have the edge, you would actually need to actually band up together with the rest of the other angels, and that I think AngelCentral is a good platform.
Sounds like a marketing pitch. Okay.
Good marketing.
So the next question is, for the startups you have chosen to invest on a portfolio basis, what is the annualized return you have obtained and over how many years?
So I'm very structured. So my view is, for you to get the maximum outcome is at least 5 to 7 years for every company, right? And so at this stage, right, around the world, we've proven it in Singapore also, 1 out of 10 is successful, 2 of them will be hanging over the water, surviving but not giving a return, 7 die, right? So you need to invest in at least 10 companies to have 1 outcome, right? So that's one comment. The other comment is this is very high risk investment. So for me, high risk investment, you need to at least pay 15 to 20% IRR, right? So you know 15% IRR over 5 years is 2x, right? And 20% IRR is 3x over 5 years, right? So for me to get a 3 times return on the fund, that means every single company within 10 companies I invest must have at least a 30 times return, right? So definitely I look at a company, if they give me a valuation at 3 million, right, I expect them to at least return 90 million over 5 years. Their valuation must hit at least 90 million before I even consider investing in them. And this without dilution. So by the time you count dilution, you probably 120 million, right? So you need to look at a company that will be 40 times the outcome that from the time I invest in, right? If it doesn't meet this medical thesis, I actually walk away immediately.
Does she want to take this one? So actually, just to share a little bit on our own portfolio, we are 28 companies. We had 2 early exits. Both were equity hires, right? So when it's equity hires, basically we only make back, I think, 101.3 only one, no, this is valuation. But we have 3 zombies. And then we have 1, we got back 20 cents on the dollar. But I think the she will share the number a lot better. We have 4 in Series A now, 3 in Series B, and 1 Series C. And so we don't have big exits yet because in angel investing you got to hold. Because if you don't hold, the early exits are not going to give you the returns. Yeah. So he can share.
Yeah, I'm the accountant household. Okay, so she outsources it all the way. So because of our workshops, we actually track our TVPIs and IRR. Prior to that, actually, I put it all at book value. So I strongly recommend putting everything in your angel investing side bucket at book value, simply because it affects your overall leverage ratio, right? If you manage your own portfolio. Since 2011 till now, we are at 25% IRR. Because we made a lot of mistakes in the beginning. We had way too big bite sizes. We invested 360K in one. It almost died. Some died. But since we started doing full time in 2015 till now, it's actually very strong. We're at 68% IRR, 3.3 TVPI, right? Which is actually beating almost all the VCs we invested in. Actually, we beat all the VCs we invested in, right? So that's why we are carrying on to do this. We think we're getting better at thinking.
So our Series C companies are Hamlet and PetSnet. PetSnet is actually a dashboard of for CIOs to use for IP research. Hamlet, I think, just came out 2 days ago on the news. Yeah. Last year, Jeffrey was the Ernst & Young Entrepreneur of the Year. Yeah. So it was an NOC story, right? Yeah. Okay. Can I come? Actually, if you have any questions, can you just raise here? Don't need to go through this. Okay, don't be shy. Okay, the next question we have, given that this is such a high-risk asset class, what net worth should people achieve before they start angel invest, and how much should they allocate as a percentage of their portfolio? We're talking about this just now.
I think on AngelCentral, there's a blog about it, right? I'm not sure whether it's Dershing or Xiaoning who actually posted it. Yeah.
I did a piece on this this one. So calculating back, later I'll share the link later.
So you should be thinking about like, so you should not allocate more than 10% of your overall portfolio, right? So then you should be, so just now Timo was saying that you should be investing in not just one, you should be investing in 10 to 20. I think 10 minimum, if you can 20 at least. So if you actually think about per company, per startup, the minimum that you can go for per syndicate is 20, 25K usually, not lower than that. So that I think if you actually do your sums, it works out to I think minimum 3 mil-ish, definitely higher if possible.
Okay, so actually that's a politically correct thing to say is you should be to invest in a fund. Okay, to be a government-endorsed MAS licensed fund investment, you need to be an AI. So based on MAS definition of the self-declaration, you should at least have 200K of salary, or your personal net worth should be at least 2 million and above. But there are a lot of investments that actually, when you talk to the startups directly, they actually do not go through the KYC check. Okay, so I think from the government's point of view, as long as the startup is not broadcasting their fundraising call, they don't need to. Actually, you don't really need to meet an, okay, am I going to get it? You don't need an AI to, yes. So it's more of, from the MAS point of view, actually, is to make sure that you know what you're doing, and they assume that when you have a certain amount of net worth, you know what you're doing. That's why there is this AI requirement. Yeah, so for our syndicates, we are trying to be a bit more kiasi, and that's why we follow this. But technically, from the startup's point of view, most of the time, they actually don't require this. Okay? Yeah, so that's why on our, it's a lot of readout. Actually, you should actually read out all this on your own. But for our platform, that's why you notice actually for us, it's more of bridging the potential investors and the startups. That's what we call an indication of interest. Okay, so you have to find out more from the founders and talk to them further to understand where they're coming from and why you're investing in them. Fair? Okay. We have a question from KL side. At what stage should the angel investors start to invest in a startup? Actually, you can invest in the ideation stage if all you want, I think. You got to form your own philosophy.
Yeah, so maybe my comment is this. There are different types of, because we have a lot of angels in our platform, so I will categorize it 2 types. One type are ready to invest on an idea, and they like the founder and they are willing to take a bet. Of course, this valuation is lower. Okay, there are other angels who only want to invest after they see sufficient traction. They want to know their revenue, what's their cost of customer acquisition, what's the lifetime value of the customer, what's their growth, right? What are the secret sauce behind your success, right? So you need to go and figure out your own investment thesis.
So yeah, I agree. So I realized that there are 2 kinds of companies in my portfolio. So one is those that are the very early type. So those companies, those startups will not be earning too much of a revenue, but the rate when you invested in them, you got a good valuation. So for those startups, you actually need to actually work more closely with the founders in terms of actually looking at whether they need to pivot, whether their business model actually makes sense. So it's a higher risk. Then there are the other kind of startups where they actually the founders actually their revenue is decent. They are growing month on month, year on year, decently. Actually, they know what they are doing, and basically you can most of the time you can hands off, and then you can be you know that they are doing their work. So depending on which kind you like, what's your personality, you find a startup that suits you. Of course, before that, you will need to be comfortable with the startups that you're investing in, because at the end of the day, every pitch that you actually see, you will see that the financial projections is always going up. Yeah. So.
Is there any type of founders you definitely will not invest in?
I think it is important for the founder to be honest and truthful to you. If the founder is actually not very it seems to be hiding something, not very truthful, then this one could be an integrity problem. So, well, at the end of the day, if you smell any red flag, then just don't do it.
I think adding on to the points there, for us, yes, we would like to see a product or a service solution that's actually got customers. So that was what Tecmo had said. I think where you're investing purely in an idea, then it would surely have to be an area that you're familiar with. And again, to how many of us, you need to find your own level of comfort, but how many of us want to invest in something that we don't understand? I mean, you can't even ask a sensible question. So I think at the end of the day, the answer to that question has to be everybody's discretion and their own comfort level, and probably, again, the amount of disposable funding they have to use and allocate accordingly.
Two questions. The first one is, do you also do debt, like SAFE or convertibles, or only equity? And the second one is a $64,000 question, which is, do you have any suggestion on how to evaluate these companies? Because it's like one of these artistic form, in my experience. So if you can share any of your experience, that would be appreciated. Thank you.
I'm going to let you go on this one, Tecmo. I think that really is the $64,000 question.
So your first question is, what instrument do you invest in? Of course, the popular ones are convertible note and equity. So convertible note actually is a debt instrument, right? So if actually the person pays, if the founder pays you back your debt and give you some interest, that doesn't make sense on my investment thesis to take this risk and get an interest and a payback. So for me, even if I look at a convertible note, I want to know at what time do I convert to equity, at what terms, and what is my outcome, right? American companies, American VCs like the SAFE note. Actually, I find the SAFE is the most unsafe note. It's not even an investment, it's just a warrant. So actually, I actually don't like SAFE, but it's very popular because this American has popularized it. All the startups can find the document, they don't need to find the legal terms and all that. So it's very popular. So sometimes we don't have a choice because everyone is using the SAFE note. So the second question is, how do you evaluate the value of the company? That's not science, unfortunately. It's an art, actually. I think there's a market price for pre-seed, no revenue, very early idea. There's a market price. So all these prices are set by VCs. So it depends on supply and demand, the amount of supply, and the VCs, how much they are willing to offer this valuation. So unfortunately, when I look at this valuation maybe 5 years ago and now, the valuation has moved. It's moved because there's much more money from VCs, and as usual, right, there's the good companies, the good startups, a lot of VCs want to invest in them, so the valuation go up as well, right? But for me, from a mathematical angle, I always look at two things. One is, can it support my long-term thesis of 5 years and 7 years, giving me my 15 to 20% return? So if they don't do this, I cannot accept this valuation. For example, if I think the company can be worth 100 million, there's no way I can support a 5 million valuation, because 5 times 20 is 100. That's too low for me, right? So, I mean, that's just one. And then you need to consider dilution and all that. So that's one thing I look at. The other thing I look at is in the journey of a startup, normally they raise at least 3 rounds or 4 rounds of fundraising. So they normally raise after 18 to 24 months. So the money will last 18 to 24 months. So I always look at what is the outcome of the company after 18 to 24 months. What is the shape of the company, and how the VCs and the industry would value that company at that stage. Of course, you're right. All the projections are, so you can take any discount or blah, 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 and come up with your own idea of the shape of the company. And for them to get to a 20 to 30 times return, the second round needs to be at least 3 to 5 times up over my valuation currently. So if after 18 to 24 months, the value cannot support at least 3 to 5 times, it means that this valuation cannot be supported.
So to add, the vast majority, so if you actually work backwards, the vast majority of the exits, except for a few exceptional cases, would be in the ballpark of a few tens of millions, let's say 20, 30, 40. You will have a few rare exceptions where you can actually exit 100, those will be the IPO types. So working with the average, you're hoping for like the 4x, 5x returns. So if you actually work backwards, your valuation when you invest should not be, most of the time, it should not be more than 10 million. So probably 5 plus minus. So that's one way of looking at it. The other way of looking at it is actually to go with the multiple of the revenues. So of course, if the startup is pre-money, then actually you can't rely on that. So it will be purely based on your assessment of the founder, the business, and so forth. But when the startup actually has some traction, a multiple of the revenue.
So just to add on to that, there's actually one thing that we look at as well is at that round, do we think that after that fundraising or after 2 to 3 rounds of fundraising, would the founders still keep enough stake in the company? Do they over-invest, over-dilute themselves? Because motivation, right? Because if, let's say after 2 rounds of fundraising, the founders are diluted to less than 50, I think that's not a good sign. Because you need the founders to have enough skin in the game, because their life is really actually quite hard. The first 5 years is really hard life. So if they do not have enough skin in the game and they actually can't draw a decent market rate salary, you can rest assured this business is not going to last very long. Okay?
Yeah, hi, thanks for this. Having a great time listening to you, learning a lot. My name is Shiva. I run a venture builder. In fact, we are situated in this building. We build businesses that make our cities more livable. My question is, how do in the exits that you've had, the few exits, how have you exited? What has been the process? Typically, when subsequent funding rounds happen, the number of outstanding shares, they increase, right? So you're diluted. At what point do your shares get acquired at a higher value and you get an exit? Is it when the company gets acquired? How do angels exit?
I think angels, so it depends on your philosophy, I would say. So Dashing and my philosophy is we follow the founders as long as they are deep committed to the business. Okay, that's why for us, our philosophy, as long as the guy is committed to the business, we'll follow him. But we have a budget cap per deal. So we know that based on our own strategy, we know how much money we can invest per deal. So we must keep our discipline. Yeah. But usually, if let's say angels, you're not providing value in that whole process, actually next round VCs, when they come in, they will want to buy you out. So when they buy you out, it's actually sometimes it's actually administrative reason. Because to manage a 0.8%, the cost of managing a 0.8% is actually the same. Yeah. So sometimes it's logistic issues. But I haven't had a good exit yet. I'm waiting for my CVC to be a good exit.
Hi, I'm Oscar. I'm actually a venture capital lawyer. I was working on the Hamlet deal and on another deal with Jane recently. I was wondering, for your direct investments, like how many hours do you spend on due diligence personally, if it's a non-syndicate, and where does the time go? Like, do you research the product, the industry, the market, the business model, or do you just research the actual founders themselves?
I will say for Hamlet, that deal in particular, Shing did most of the due diligence. And so our process is actually one person will go deep. But the thing is, our family rule is both of us must like it. Both of us must be okay with it. So in that sense, we have two brains working on it. Yeah. But for me, I definitely has to meet the founder. So I met Johan over some kopitiam. And then it's really true that he convinced me of what he's doing, and then verified the fact that the two of them, so Johan and Zinos are both actually working on it full time. Because one thing I'm not most worried, because I realize some founders, it's a life too, right? Because they usually try to play safe, so they will work part-time, and then they will tell you it's actually full-time, but it's actually not full-time. So you actually got to have that conversation to validate that, some of the parts. So it's go back to the trust. And I think it's very difficult to establish trust if you don't have that face time. Yeah, but due diligence actually depends on how late stage. So you need to set your own, so like what India said, right? You need to set your own philosophy. You got to do your homework. You got to do what's your ideal portfolio, what you want your ideal startup to look at. But of course you got to plug in a certain amount of flexibility, because otherwise you are going to template your own founding, your teams.
So maybe give you my comment. Normally if I follow other people, I would check less. I only look at what I want to look. But if I'm the only person who does the investment, I lead around, right? Recently, like MedTrack, right? So you can do very early kind of thing before you spend enough time. So for example, the founder will tell you he's doing this, he's spending money on this, he's getting this revenue. The very easy thing for you to do is, okay, show me your last month bank statement. In 10 minutes, you look at what is coming, what's going out, and you ask a few questions. Definitely, you immediately would know that whatever he says is true, right? Actually, and then ask some questions about how do you make these decisions and all that. So that's my first cut before I go in and do much more work, right? Of course, when you do much more work, then you want to meet the customers, you want to meet the suppliers, you meet some people to go and check some of the other discussions. You meet the staff, you meet the CTO, the other founding members, and so you can do much more. But normally you do some early filter to go and figure out whether there are a company where you would like.
Can I pick you up for everybody on that? Right, as an angel, as a small investor, and I don't know how everybody in the room feels that you're going to march in and say, okay, could you show me all your bank statements? How confident do you think our angels should be as a community to demand that? Because I think there would be a reluctance, to be honest.
Okay, so I've got two advantages, right? So number one, I mentor a lot of startups. So every year I mentor easily 20 companies, 20 startups. So when I mentor them, I always have the eyes, the goggles of to help you. So I always start from this angle to, okay, can you show me so that I can maybe figure out there's areas that I can help you with. So when you build your reputation like that, people are more willing to open up for you. So not just because I'm investing or all that, because I think they potentially feel that they can learn something from it. So that's one. But when I agree with you, if I'm a small investor following other people, it's much more difficult, right? But if I'm leading a syndicate, then I feel that I'm responsible for all the angels who follow me on this syndicate. So I represent it. But my view is, as an angel, don't be afraid to ask. Don't feel that your money is too small. Because for me, my money is personal money, my money. So before I give you a cent of my money, I want to validate that my money is worth spending. So of course, if you don't want to share with me, that's fine. But I can walk away, there's always another deal.
I think it's also with the founders, I found that it also matters if they think that you are a genuine investor. Because they are spending, when they are fundraising at that point, they are talking to so many people, and they are also trying to suss out who is really serious, and I should spend my time investing in sharing information. But I think it's very fair to ask the founders if they are fundraising, how much runway do they have left? I mean, and you need to know that the answer, they need to know the answer is not going to scare you away.
Okay, so we have one.
I think the cases where, the scariest cases are where you actually take a leap of faith, the startups who are not based in Singapore. So in Singapore, you know the law and the ACRA and everything, and then when you have a startup that's in another country, the language might not be English, and so those are the cases where you would actually take a leap of faith. So you can demand to see the bank account, you may or may not get it. You can demand to see the company registration, you may or may not get it. So at the end of the day, it's about the risk mitigation.
Okay, so just share a story. I did an investment in Helsinki without understanding the tax obligation was Singaporean in an EU country. After that, I spent 2,000 euros to figure out my tax obligation. So that one I didn't do enough due diligence. But the company actually doing well now. Okay. Sorry, I don't quite understand. How do you arbitrage?
How long term are we talking about?
So a normal VC fund is about 7 years, right? So you're talking about, basically it's very patient capital to not look for any returns in that 7 years.
So far, none of the things I looked at is that long term in terms of having some kind of a progress.
So I think if you're talking about deep tech, there's a chance that it will fall into that category. So because the founders might actually be scientists, so I'm a scientist myself, so I understand. So the founders might actually be scientists, and they're working on a world-changing technology, and they need more funds to actually build the product, put the prototype, get it to market, and all that. So I think for an angel to invest in that, you would need a huge risk appetite, and you don't expect your money back for a long time. And there's a huge chance, I mean, to be frank, that things might not work out. So I think at the end of the day, it depends on your risk appetite as an angel.
Does that answer? Okay. Okay, I want to bring up this one that had 3 votes. Global hubs are in Silicon Valley, which is a place for innovation, and China, where you have very hungry entrepreneurs. They work 996, meaning they work 9 a.m. to 9 p.m. 6 days a week. What is lacking in Singapore's startup ecosystem? Basically, are Singaporean founders hungry enough? Do you think so?
It ties into a discussion that one of our founders was invited to sit on a panel and talk about entrepreneurship. And I think Singapore Inc. is selling the entrepreneur dream as something that is so easy, right? Everybody should be an entrepreneur. And I suggested to our particular founder that perhaps a little bit of a reality dose, because really the entrepreneurship journey is hard, it's tough, it's lonely, and it's 24 hours a day, 365 days a year, and I think we've tended to make it terribly glamorous. And the reality, surely, for most startups is not terribly glamorous. So that would be my comment, I think, in there.
I would directly relate to that. So I'm a founder, studio founder. I started my first company that I built about 10 years ago.
Right.
About 50 people. And now I started the next one.
Congratulations. Yeah.
What I see in Singapore, and I can compare that directly also to Berlin, is there's a lot of lifestyle entrepreneurship.
Yeah.
I mean, there are plenty of very serious entrepreneurs, and it is hard work. Everything actually moves to the edge of your life, and you concentrate on getting your baby to come.
Yep.
But there's a lot of also who I travel around for a year around the world, or where I hang out with other people, and that has nothing to do with the
Yep. Yep.
It's very true. So as an angel investor, for me, it's very important to try to distinguish between the two. And so for me, I don't think I would ever invest on plan. So I always need to see sufficient execution to have the confidence that the founders are really trying to do this, and that they appreciate how hard it is. And one of the reasons I also invest is I definitely agree with what Deshing said. It's a way of living vicariously through them. And I have a lot of respect for the people who have decided to make that leap and is trying to build a business and create new value.
So I think I agree with Jane that there were a lot of hype in the past 5 to 10 years, and a lot of people are in this space for the wrong reason. So that's why, go back to the founder, motivation, what drive them to make this, and is there enough execution to prove that they really know this as a business rather than just an idea at the back of their head? So in the past years, we actually noticed there's actually one group of what I call the trade fair entrepreneurs. They're always at all events, rubbing shoulder, being seen at the right place. But then the thing is, are they actually building a business? You keep seeing it at the same place, but then the business is not growing. The business keeps changing. Yeah, so personally, I actually wonder why some startups like to call themselves serial entrepreneurs. To me, it's actually a very negative term. It just means nothing works. But they actually thought that it's it's a pride thing, right? But to me, just because one business takes at least 5 to 10 years to build. So if you're 25-year-old and you call yourself a serial entrepreneur, do you like every 6 months jump ship? So they don't realize what it means. So some of the, I know actually a lot of founders are tuning in. Please know what serial entrepreneurship, the connotation of what it means. Okay? We are running out of time apparently, but we actually have a lot of questions. Actually, one very interesting question is how do we become a partner at AngelCentral? So that one we can talk offline. Yeah, okay? We definitely look for more partners to work with. Yeah. So we'll hang around for questions, so please come and talk to us. And I hope that actually today is also part of our marketing drive for us to grow more members. So actually I think Tuesday we had one of our most successful syndication office visits. Actually the company is at 1.4 million. You went in, right? Oh, you didn't go in? You went, but then because she couldn't make it the office
the
visit.
day job challenge.
Day job challenge. Yeah, so actually part of the benefits of being a member with us is actually on a money basis we actually have a pitch day. But if the members can't come down for the pitch, we actually video the startup pitch. So through the platform you actually will view the pitch and the information through the platform. But be very clear, the platform is to bridge startups with angel investors. And actually one question here is about what's the difference between angel investing and crowdsourcing. Crowdsourcing means you open up for the people to view and to nominate themselves to be an investor. Angel investing is, I think from the investor's point of view, actually, I think actually not so much difference, but maybe a check size difference. But from the founder's point of view, there is a very big connotation difference. So we can share about it. Whoever asks this question, we can talk about it offline. Okay, thank you so much. Are we going to take a photo? Can we gather around and take photo together?